It's a familiar feeling, isn't it? That nagging sense of unease, the whispers of doubt swirling around the seemingly invincible towers of Wall Street. The air is thick with the scent of risk, a cocktail of exuberance and trepidation. We've been here before. Remember 2008? The year the music stopped, the champagne went flat, and the bottom fell out of the world as we knew it. The year the global economy teetered on the brink, staring into the abyss of financial ruin. Could it happen again? Are we on the precipice of another market meltdown? A replay of the 2008 crash that sent shockwaves across the globe? The parallels are eerie, the warning signs flashing red. The same intoxicating mix of cheap credit, speculative frenzy, and regulatory blind spots that fueled the last crisis is back with a vengeance. It's like watching a horror movie for the second time, knowing the jump scare is coming but powerless to stop it. But this time the stakes are even higher. Let's rewind the clock back to 2008, a year that will forever be etched in the annals of financial history. The housing bubble, inflated by years of reckless lending and unchecked speculation, finally burst. Millions of homeowners, saddled with mortgages they couldn't afford, found themselves underwater, their dreams of homeownership transformed into nightmares of foreclosure. The contagion spread like wildfire, engulfing banks, insurance companies, and investment firms. Lehman Brothers, a titan of Wall Street, crumbled under the weight of its toxic assets, sending shockwaves through the global financial system. Credit markets froze, businesses ground to a halt, and panic swept across the globe. The world watched in disbelief as the seemingly invincible edifice of modern capitalism teetered on the brink of collapse. The consequences were dire. Millions lost their jobs, their homes, their life savings. The global economy plunged into the worst recession since the Great Depression. Governments around the world scrambled to contain the damage, injecting trillions of dollars into the financial system to prevent a complete meltdown. The scars of 2008 run deep, a stark reminder of the fragility of our interconnected financial world. Fast forward to 2024, and the echoes of 2008 are growing louder. The stock market, fueled by years of easy money and speculative fervor, is showing signs of strain. Valuations are at historic highs, detached from economic fundamentals. The cryptocurrency market, a wild west of volatile assets and unproven technology, is experiencing a dramatic boom and bust cycle, leaving investors reeling from whiplash. Inflation, once a distant memory, is rearing its ugly head, eroding the purchasing power of consumers and squeezing household budgets. Supply chain disruptions, exacerbated by geopolitical tensions and a lingering pandemic, are fueling price increases and creating shortages of essential goods. The Federal Reserve, faced with a daunting task of taming inflation without triggering a recession, is walking a tightrope, its every move scrutinized by anxious markets. The warning signs are clear, the cracks in the facade becoming increasingly visible. The question is not whether another market correction is coming, but when, how severe, and what dominoes it will topple in its wake. The specter of 2008 looms large, a haunting reminder of the devastating consequences of unchecked risk and complacency. Amidst the swirling anxieties and market jitters, a new phrase has entered the lexicon of financial doom-mongering: currency reset. It's a term that evokes both intrigue and trepidation, whispered in hushed tones in the corridors of power and debated fiercely in online forums. But what exactly does it mean, and could it be the answer to our economic woes or the harbinger of even greater chaos? In essence, a currency reset refers to a significant change in a country's monetary system, typically involving the devaluation of the existing currency and the introduction of a new one. This drastic measure is often seen as a last resort, a way to wipe the slate clean and address deep-seated economic imbalances such as unsustainable debt levels or hyperinflation. Proponents of a currency reset argue that it can provide a fresh start, a chance to rebuild a more stable and equitable financial system. However, critics warn of the potential for economic upheaval, social unrest, and a loss of confidence in the financial system. A currency reset is not a magic bullet. It's a complex and risky undertaking with far-reaching consequences. Its success hinges on a delicate balance of economic, political, and social factors, and the outcome is far from certain. The very notion of a currency reset, whether it materializes or not, underscores the depth of our current economic anxieties and the search for solutions that may lie outside the conventional playbook.